Good morning from our global headquarters in New York. I'm Danny Berger. Manus Cranny is off this week. Welcome to Bloomberg Brief. Let's set your agenda.
The tariffs are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen.
President Trump says levies will hit Canada and Mexico next month as planned, but U.S. officials say the timing isn't set in stone. Tightening grip on chips, Washington plans even tougher restrictions on China's access. And growth's trajectory questioned, Treasury yields sink to their lowest level of the year. 3 days of selling for U.S. stocks. We are under 6,000 for the S&P. Will it be a fourth day? Easily the longest streak so far of this year. We're down 1/3%. NASDAQ 100 futures fared the worst, down 0.5%. The ADR is getting hit hard. Those of China, given those chip restrictions I just mentioned. Russell 2000 futures, those fall by about 1/3%. But good news, bonds are working for a place of safety. By the way, a really strong 2-year auction yesterday. There's clearly demand for the bond market. We are lower by another 6, let's call it 7 basis points for your 10-year yields, 4.3%. NYMEX crude, that also moving lower after higher yesterday, which, by the way, the Trump administration placing more sanctions on Iran yesterday, something that would have been headline grabbing if it was at this point last year, but of course gets buried under the news this time. NYMEX crude trading at $70.66. A quick look at Bitcoin short. Crypto has its own issues. There was a hack of one Dubai-based exchange. Even so, we've fallen nearly 8% over the past 2 days, down below 90,000. Perhaps encapsulates some of the animal spirits post-Trump's election that seem to have gone missing. We also have some individual stocks we are keeping our eye on. I mentioned the Chinese ADRs in the U.S., which are absolutely underperforming their Chinese counterpart. Alibaba, though, that is rising. In the pre-market, it is up 4%. That's despite fears that President Trump will move to limit investments between the U.S. and China. That caused a decline in Chinese stocks yesterday, so maybe what we're seeing is something of a rebound. Tesla, we got the European sales for the car maker. It is down only 0.2%, but sales plunged 45% last month across Europe. Rival car makers saw a surge in demand for EVs. The overall EV market, that surged 37%. Meanwhile, Novo Nordisk in the European trade rising to the highest level since December. The U.S. firm Him and Hers Health said it would stop soon selling some compound weight loss drugs, considering they've been taken off the shortage list. In just a few moments, we're going to be catching up with Bailey of BlackRock. Later this hour, we'll talk with Jack Caffrey of JPMorgan, along with Bailey Hutchison, former U.S. permanent representative to NATO, at the Bank of America Investor Summit in Dubai. Don't miss that one. But first, sticking with the U.S., BlackRock's Bailey stays optimistic on stocks this year, writing, quote, "We still think U.S. equities can outperform in 2025, led by tech, even as Europe's strong start to the year. Yet, we broaden our risk on view, upgrading European stocks." I'm pleased to say that Wade joins us now, Chief Global Investment Strategist at BlackRock. Great to see you, Wade. On this itself, because it hasn't exactly played out this way. We've had 3 days of selling in the U.S. As you note, Europe is outperforming. Tech, Mag 7, is down on the year. What to you says that dynamic won't necessarily last?
What is really interesting is that after a very concentrated rally in U.S. markets, U.S. equity market in recent years, the world is set up a bit differently coming into 2025. The bar is quite high, so the U.S. market needs to meet an ever-rising bar, whereas for the rest of the world, Europe or China for that matter, actually just a few things, one of the few things needs to go right for sentiment to turn around, which is why we actually have seen a broadening out of the rally and a catch-up for the rest of the world relative to the U.S. Now, having said that, let's look at the dimensions of U.S. exceptionalism. We're talking about greater representation in tech. We're talking about greater fiscal spend. We're talking about energy independence. We're talking about deeper capital market, more robust risk-taking. I think the U.S. is still leading in most, if not all, of these dimensions. The gap may be narrowing, but the U.S. is still leading, which is why, as we kind of up our conviction towards the rest of the world, in this particular case, European equities, is not coming at the cost of U.S. equities. We're still overweight U.S. equities.
So it's not a zero sum. If we can tackle some of the list of the U.S. exceptionalism, because it feels like that is something that is being questioned. Let's start with fiscal spend, because you look at Doge's efforts, and the read, at least from what the market is saying, is that so far the first things we're getting are growth negative from the Trump administration. Do you expect that to change?
Well, yes, Doge's effort of cutting fiscal spend, all else equal, would translate into lower growth impulses. But we also know that the Trump administration would love a more robust growth environment. They're talking about 3% real growth target, maybe 2.5% is more realistic. But the bottom line is, if we want to focus on growth, then fiscal needs to be supportive, and that is inflationary. And also, if we want to focus on closing or narrowing the trade balance and through tariffs, for example. So that means that tariffs gets imposed without proper FX adjustment. That is inflationary as well. So when we bring all of this together, a lot of the policies actually points to higher inflation. So when you say, Danny, it's not a zero-sum game from a whole portfolio perspective, when we make these adjustments to our investment views, it is a zero-sum game. It needs to be balanced somewhere. And we're actually lowering our conviction to long-duration U.S. Treasuries to support the upgrade for European equities. Currently, U.S. 10-year at just about 4.3% is underappreciating the high-for-longer inflationary environment that we're heading towards, in our view.
What do you do with European duration? Because there's this question of the spending we're going to get out of Europe. There's a new defense fund, presumably coming from Germany with a German-led effort. We didn't get the reforms of a debt break considering the results of the German election. But can you buy European duration at this point, Wei?
Right now, we prefer European durations over U.S. durations more because of the greater room for the ECB to cut rates in comparison with the U.S. But I would say that actually European government bonds, U.S. government bonds, they're very correlated. So if we're talking about an environment where greater fiscal spend is direction of travel, look at defense spending, direction of travel, for example, through NATO, and then I actually think that that represents longer-term kind of challenges for durations, including European durations. But right now, because of the cash path expectation divergence between the Fed and the ECB, we have a slight preference for European government bonds over U.S.
So if we can go back and tackle one of the other things of U.S. exceptionalism that you mentioned, and that is the greater share of tech. We've seen recently what happens when tech doesn't play along in this market, and that is an overall flat market. One of the theses of challenging tech has been one where Chinese tech has vastly outperformed. Alibaba is spending more money. We can rehash the DeepSeek stuff if we want. To what degree does that threaten the prevalence of U.S. tech?
I think in the same way that we have seen a broadening out theme from the US to the rest of the world, we're also seeing a bit of a broadening out theme within the tech space as well. So far, from the US and China tech, Hutchinson tech, even after the last days of market volatility, is still up more than 27% on the year. So a bit of a broadening out in terms of region within tech, and also a bit of broadening out within the subsectors of tech, a bit of a rotation from hardware into software, for example. A bit of a broadening out theme is cutting through both kind of the equity space, but also the AI implementation space. Now, importantly, what I care about is if tech companies, if these hyperscalers are slowing down their capex spend, they are walking back from their capex commitment. So far, based on the earnings season that is still ongoing this week, all eyes on NVIDIA on the 26th. But so far, based on the guidance of these hyperscalers, they are actually upping their capex spend target for this year, $320 billion of capex, which is 40% higher than what was already a record year last year. So the hyperscalers are continuing to spend because the pursuit for net new model, the pursuit for AGI, the pursuit for greater adoption across industries, that hasn't really slowed down, despite the fact that we have a potentially more efficient model. The commoditization piece is getting broadening out. So because of all of this, we continue to like tech, but I think this week's NVIDIA earnings and their guidance will set the mood music for the foreseeable future for now.
Yeah, NVIDIA earnings coming after the market close tomorrow. Wei, really wonderful to catch up with you. Thank you for joining us this morning. Wei Li of BlackRock. Now let's get some of the other top stories that are trending on the terminal this morning. Unilever CEO Heinz Schumacher will step down in a surprise move after less than 2 years. He will be replaced by Fernando Fernandez, the current CFO. Schumacher kicked off a shakeup that included plans to spin off its ice cream business and cutting costs. The CEO change will take effect in March. Bloomberg sources say that SpaceX is seeking to deploy Starlink satellite internet terminals to help upgrade the FAA's national airspace system. Musk approved a shipment of 4,000 Starlink terminals to the FAA last week. A spokesperson for the agency said that they confirmed they are testing one terminal in Atlantic City and 2 terminals at non-safety critical sites in Alaska. President Xi Jinping reaffirmed his relationship with President Vladimir Putin on the 3rd anniversary of Russia's invasion of Ukraine. Xi expressed China's readiness to assist in finding ways for a peaceful resolution of the Ukrainian conflict. Xi and Putin plan to visit each other this year, with Xi traveling to Moscow in May. Coming up on the show, trade tensions, chip curbs, decoupling fears. We're going to focus on tariffs and the U.S. and China next on your brief.
Are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen. I mean, you know, who can blame them if they made these great deals with the United States, took advantage of the United States?
President Trump saying that tariffs indeed will be coming as planned after the delay to both Mexico and Canada tariffs. That, along with speculation of chip curbs, according to Bloomberg sources, took U.S. equities down. We are under 6,000 on the S&P 500. 3 consecutive days of selling, and that continues into the future session. We are down 0.2%. The dollar, little change this morning. But here's the good news for all of that, is that bonds as a haven has been working. 4.3% is where we stand on your U.S. 10-year yield. That is lower by 6.5 basis points this morning, adding to some of the dour attitude. Sure, it was tariffs. Sure, it was chip curbs, but it was also the softer data that we have had over the past couple of days. It is both PMIs, which were surprisingly weak, and University of Michigan sentiment survey, which showed inflation expectations higher, but consumer sentiment lower. Add to all of that what we are getting out of the Trump administration. That is Doge job cuts. It seems that the first indications we're getting from the Trump administration is one that is growth negative, not necessarily growth positive. Maybe that will come later, as Wei Li from BlackRock was just saying to us, that there will be more fiscal spend coming, and that will help support the markets. But as I say, one of the things that seems to be setting off this morning is the Trump administration, according to our sources, sketching out even tougher curbs on U.S. chips for China. Again, we have learned that the plans include pressuring key allies, Japan and the Netherlands, to ramp up their restrictions on China's chip industry. That just escalates tensions between the U.S. and China even further. Joining us is our tech lead out of Europe. It is Bloomberg's Tom McKenzie. Tom, there used to be a day where every day we'd wake up and say, what are the tougher curbs that we have on China this time, as if it couldn't get even tougher. What does it appear that the Trump administration is discussing?
Yeah, and if there was any expectation, Danny, that the Trump administration would be walking easy on these restrictions, then this is a reminder that they will not be. In fact, they're taking the foundation that was built by the Biden administration and building on that, according to our reporting, with some additional features as well. So, for example, you talk about Japan and the Netherlands. They have sent officials over to both of those countries to pressure officials in the countries to put pressure on their own companies. Tokyo Electron in Japan, a provider of semiconductor equipment, and ASML, of course, in the Netherlands, the maker of those EUV lithography machines, putting pressure on them to restrict the access of their engineers servicing some of that kit in the Chinese markets. That's one part of it. Again, building on what the Biden administration had put in place. The other part is putting in place, or at least considering, reducing the cap applied to certain countries in terms of the shipment of AI accelerators. We know that as a framework that was built out by the Biden administration. It seems like they're looking to add additional restrictions on that front. And then with the individual companies in focus, NVIDIA, that can still supply some AI chips into the Chinese market, it looks like the Trump administration is even considering reducing the level at which those chips can be sent in, or in fact expanding the basket essentially of the restricted chips when it comes to NVIDIA, which they can send into the Chinese market. So those are a couple of key factors. There's also another line in this, which is the Trump administration potentially looking at sanctioning some of the key Chinese companies involved in building out their own domestic supply of semiconductors. So there's a lot in there. Some of it's new. A lot of it is building on what the Biden administration had already put in place.
Well, lucky for us, we get NVIDIA earnings tomorrow, so we'll get live commentary on what some of the changes might mean. Tom, even though they're putting on these restrictions, there seems to be this real enthusiasm around Chinese tech. Michael Hartnett from Bank of America just speaking with Guy Johnson moments ago, saying that at least for equity flows, it's clear that people are moving out of U.S. tech into Chinese tech. Does that suggest that these efforts don't make a difference, that China is advancing with or without the U.S.?
Well, there's a tension, isn't there, for those looking to get some exposure to the innovation that is happening in the Chinese market. And as you say, a key question going forward longer term is to what extent that innovation can continue, to what extent the efforts of DeepSeek and Huawei, Baidu and Alibaba will be derailed by the kind of restrictions we're seeing putting in place. So far, there isn't a huge amount of evidence that the restrictions put in place so far have done that. We've seen the innovation coming through from DeepSeek. We've seen what's happening with Alibaba and Baidu and others. They are still able to access some of this hardware, whether that's by third parties or other sources. There's an argument that the further and more restrictions you put on place, the more it accelerates the R&D spend domestically in China to build that out. There's a tension for investors, clearly. We've seen money flows, interestingly, from Hong Kong, mainland shares, mainland investors into Hong Kong. But of course, you've seen US and foreign investors in the Chinese markets, Hong Kong markets, starting to retrace on some of the tariff and restriction news that's come through.
Yeah, remarkable. You're seeing dip buying happening there, but not necessarily in the U.S. Tom, thank you so much. Bloomberg's Tom McKenzie. Now, to the greater tariffs, where Trump is saying that everything is moving on the timeline of reimposing Mexico and Canada tariffs. Joining us is Brendan Murray, who tracks trade for Bloomberg, who is in Cape Town at the G20 Finance Minister Summit. Brendan, let's start with this. Trump says they're going ahead. A U.S. official, though, speaking anonymously to Bloomberg, saying that they haven't yet decided on the timing. Is this a situation of believe Trump, trust Trump when he says that this is occurring?
Yeah, I mean, I think you have to take the president at his word, but you know, the guidance from his officials is that that deadline of March 4th is still a bit flexible. So the overall impact of that kind of message is uncertainty, and we're seeing a lot of it already here in Cape Town. Some of the G20 finance ministers, central bankers who are already talking to us saying, you know, this is no way to conduct a global economy where stability is important. So that'll be one of the big issues this week that we'll stay on top of, is just how much of a headwind this idea of tariffs and, you know, essentially a North American trade war starting next week will weigh on the economic outlook and just the general mood in the room.
To that point, Scott Bessent isn't going to be there. The U.S. Treasury Secretary, arguably one of the most important finance ministers at this time when there's so much uncertainty coming from U.S. policy. Brendan, how is that coloring some of the conversations there?
Yeah, exactly. You know, the U.S. Invented the G20, if you will, after the Asian financial crisis in the late 90s, and has always been the big convener of these important countries, 85% of the global economy, and they have been a source of it's been a source of stability and certainty. And now the U.S. is with its tariff threats, you know, pretty much on all of its major trading partners are now the source of disruption and discord here. So Bessent's absence will be noticed. He's sending other Treasury officials apparently in his place to relay the message from the Trump administration. But the symbolism there is not lost on a lot of the people who observe these kinds of meetings.
Brendan, really looking forward to catching up after the G20 finance ministers meeting and seeing what the outcome is. Brendan, thanks so much. Bloomberg's Brendan Murray. Coming up on the show, the Doge chaos persists. The Trump administration now breaks with Elon Musk's directive on the controversial email replies. Elon Musk has more to say. We'll bring you that next on Bloomberg Brief. Let's take a look at the front pages this morning. The FT begins with this: President Trump breaking with allies, withdrawing U.S. condemnation of Russia's 2022 invasion as he aims to end the war. Both the U.S. and Russia voted against a European-backed resolution that calls out Moscow's full-scale invasion of Ukraine. Meanwhile, we have this on the Bloomberg. Germany's chancellor-in-waiting Merz is said to be in talks to approve special defense spending. The plan is to push a vote on a package through the current parliament before it dissolves. Finally, the New York Times has this, reporting that the Trump administration is breaking with Musk's directive on his email replies to keep your job. The Office of Personnel Management clarifying that many federal employees would be exempt from responding. Elon Musk doubling down, though, on X late last night, writing, subject to the discretion of the president, they will be given another chance. Failure to respond will this time result in termination. Okay, coming up, JPMorgan's Jack Caffrey joins us next. Is an equity market running out of steam? We are on track for a fourth consecutive day of losses. That's coming up. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. On time, on schedule, President Trump says tariffs will hit Canada and Mexico as planned. Plus, his team seeks to toughen up chip controls over China. Growth trajectory question: Treasury yields sink to their lowest levels of the year. And Bank of America's Global Investor Summit kicks off. Don't miss our interview with the former U.S. representative to NATO, Bailey Hutchison, live from Dubai. Are we set for a fourth day of decline? Certainly looks that way given what futures are doing this morning. NASDAQ 100 futures lead the drop. We've seen the worst 3 days of decline so far of the year, considering this is the only time we've seen 3 days of declines. We are under 6,000 for your S&P 500 futures, but bonds are acting as a haven. Well bid, a really strong 2-year auction yesterday, lower by another 5 basis points on the front end. Your 10-year is at 433, lower by 6 basis points this morning. Meanwhile, NYMEX crude a slight bid. More Iran sanctions came yesterday. Meanwhile, Bitcoin, here's a sign maybe some of the animal spirits don't look as robust as they did. It's down 8.4% in the past 2 days. We are below 88,000. There was a hack on one specific crypto exchange in Dubai that really hurt sentiment, but clearly White House policy not coming to the rescue for crypto. Meanwhile, when you look at what's been working and what hasn't been working this year, there's been a clear divergence. It is the defensive and more safety-oriented sectors that have done better. S&P healthcare, consumer staples, the two best performing sectors year to date, up 7% and 6%. But the more growth-sensitive assets like consumer discretionary, those have fallen by 4.25% so far this year. Joining us now is Jack Caffrey, Equity Portfolio Manager at JPMorgan Asset Management. Jack, really great to see you. This is something different than perhaps what we thought would happen this year. It was animal spirits, it was small caps, it was cyclicals that were supposed to do well. What do you make of the fact that that hasn't played out so far?
I think it speaks to you had somewhat more stretched valuations, certainly in the technology sector. And given that technology is, call it 30% plus of the broad market, almost 40% when we add in the communication stocks, which are really tech stocks in a different GIC. I mean, the reality is that if those don't do well, then the market on a headline basis doesn't do well, and that effectively sectors that people have to some extent ignored have done much better. Demand for staples is there day in and day out. That's why they're effectively the staple. No one chooses to get sick, and so therefore healthcare can, again, be a little bit better insulated. But that said, the fact that we were expecting a stronger dollar was expected to weigh on the consumer staples. So I think there's some interesting cross currents, and part of that is trying to understand what is the direction of the economy, which can be what is the direction of, of policy.
Certainly. And the policy mix we've gotten, and perhaps this is why you've seen some of this, is it has been one of cuts. It has been one of Doge. You haven't necessarily gotten the deregulation M&A boost that many people thought there would be. how do you judge whether those job cuts have wider ramifications for the world? In other words, can the U.S. survive a mini-recession, let's call it, in just D.C. and the surrounding areas?
Well, I think that gets really interesting because you almost have to go back to like the very end of the 1980s, early 1990s, when the U.S. experienced a peace dividend. And at that point in time, you saw massive consolidation in the defense stocks. You saw massive layoffs in the defense industry, which was particularly negatively impactful for California, kicking off effectively a state-level recession, but in an economy that's number 6 in the world. So a little bit more problematic, perhaps, than what might be experienced in North Virginia or in Maryland. Flip side, though, is government workers are highly educated. They probably, at the margin, are somewhat more risk-averse than having gone to public service rather than private service. And the security that they thought they had up until a month ago might have allowed them to be more willing to spend. The reality is government jobs are not just in Washington. They're all over. They work for the Department of Interior. They're all over. They wind up, you've shockingly found out that a large portion of the budget of the University of Alabama health system is funded by the National Institute of Health. And so suddenly, when you say what stays in D.C. might not, or what cuts in D.C. might not actually stay in D.C., I think that's something to be mindful of. And to the extent people are enthusiastic about reducing government spending, the fact is the cut hits now, the spending hit is now, the prospect of growth from unleashing a deregulated economy is still on the come or still on the hope, and that might hinge on where interest rates wind up going.
Are you changing what you're investing at all in anticipation of this, or is there specific data that you're looking out for in order to make a change to accommodate for weaker growth?
Well, I think at the margin, we spend so much time talking about what the jobs report on Friday looks like. I want us to move a day earlier and think about Thursday. Are we going to see an increase in layoffs from wherever they come from? Because even if you work as a contractor with the government, to the extent they're not getting paid, you may actually start seeing, the private sector suppliers of government being pinched first before the government comes through. We wind up, looking to X as a policy platform in terms of answer this email, not answer this email. That in and of itself is confusing. Who is my boss and who do I listen to? And so I care very much about initial claims. I would love to see a housing market restart. And so to the extent we are seeing some easing of that 10-year yield, offsetting what could be an unusually tight mortgage market, interesting. The balance between Fed funds really affecting what the consumer can spend on, financed off of credit cards, versus what a corporate investment decision more anchored off of that 10-year winds up being, I think, another interesting split that we wind up needing to pay a lot more attention to, and something the Secretary of Treasury alluded to a few weeks ago when he said, we want interest rates lower, but we're not going to force the Fed to do it. We actually want to try to engineer a lower 10-year. So I think there's a recognition that I need to restart capital spending.
So how are you positioned then amid all this?
Well, depending on the two portfolios I run, one generally looks with a 3 to 5 year horizon.
Right.
And so what I see today is more noise rather than news, and not really adjusting portfolios in the aggregate. The other portfolio I run the value sleeve of an overall portfolio. There we remain very excited about what is going on in my growth partners are very excited about what they're seeing. On the value side, though, we have a really large overweight to financials, anticipating an eventual push for deregulation, perhaps a fewer capital restrictions being placed on the financial companies, maybe a little bit more clarity on what a stress test looks like. One company actually volunteered to be subject to the stress test to demonstrate how powerful they have improved the quality of their operations over the last several years. So I think it's really interesting. And as a reminder, if you're taking that multi-year look, if you're earlier in your career, you actually like the down days. That's the chance to actually be a buyer of things with lower expectations. And as a value investor, lower expectations are that much easier to beat.
Right, especially in a market where it felt like we were just melting up day after day, so it's probably welcome. Does it concern you at all, though, that we haven't gotten that big deregulatory push, that you haven't seen M&A come back, and even there's been less volatility in the market, so for financials, the trading figures probably don't look as robust as we thought they might be?
Trading has been very robust year to date. I think it's hard to think back of a day that wasn't holiday shortened, where you've seen, quote, a below average trading day, at least in the equity market. I think ultimately we still need to get a few seats filled. We still continue to have hearings, and people are policy. That all said, some of the choices that have been picked we think about the Secretary of Labor is seen as actually pro-union.
Yeah.
That was certainly not something people were expecting. Some of the names advanced in terms of trying to take on roles in the FTC have had a somewhat more divergent view of what antitrust should look like on a going forward basis. But we all know that the alternative asset managers have boatloads of capital for both either their private equity funds or their credit funds to support their private equity funds. So I think getting a little bit more clarity about what the merger review process will look like will certainly be helpful. I think you certainly also have a lot of perhaps held up capital that's been looking to be realized through the IPO market, and that market remains a little bit more frozen, again, trying to get a better sense of what you can offer, how you can offer it, and investor appetite for companies which still are being rewarded on the basis of revenue growth without necessarily bringing the margin expansion that you've wanted to see historically in the past to support an IPO.
So you're just waiting for clarity, basically, on many fronts, it sounds like.
I am looking for clarity, but the reality is I'm never going to get clarity. And once you get it, it's very expensive. So then the trade-off is, where can I find things that are cheap?
Yeah.
And the reality is an S&P at 22 times earnings is not an explicitly cheap market. You do find things that look very cheap, but they wind up being highly, highly cyclical. And leaning into that cyclicality requires a little bit more bravery and a little less comfort in terms of either dividends or consistent cash flows than I feel comfortable with taking at this point in time.
Jack, we have to leave it there. Always a pleasure to have you on. Thank you so much for joining us nice and early here on Bloomberg Brief. That's Jack Caffrey of JPMorgan Asset Management. All right, let's get you some other stories that are trending on the terminal this morning. President Trump said the tariffs scheduled to hit Canada and Mexico next month are still happening and moving rapidly. He was asked if they would go into effect next week as he fielded questions during a joint press conference with French President Emmanuel Macron.
Going forward, on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen. I mean, who can blame them if they made these great deals with the United States, took advantage of the United States?
Elsewhere in Washington, Bloomberg sources say that the Trump administration is preparing to expand efforts to limit China's tech advancements. That includes tougher semi-curbs and pressuring allies to escalate restrictions on China's chip industry. A White House representative did not immediately respond to a request for comment. In Europe, Unilever CEO Ein Schumacher will step down in a surprise move after less than 2 years. He will be replaced by Fernando Fernandez, the current CFO. Schumacher kicked off a shakeup that included plans to spin off its ice cream business and cutting costs. The CEO effect will take change in March. Schumacher will leave the company on May 31st. Now, as we bring you to the break, a quick check on your markets. S&P 500 futures fall after 3 days of declines. We're below 6,000 with your U.S. 10-year yield getting a bid lower by 6 basis points, 4.3%. Coming up, we are live from Dubai at the Bank of America Investor Summit with Bailey Hutchison, the former U.S. permanent representative to NATO. It's coming up next. It's your Bloomberg Brief. Danny Berger here in New York. The Bank of America Investor Summit is underway in Dubai with European defense spending in sharp focus. Bloomberg's Guy Johnson has a timely conversation and a special guest to bring us. Good morning, Guy.
Good morning, Danny. Thank you very much indeed. Yeah, I'm joined by Bailey Hutchison, former United States permanent representative to NATO, a perfect person to talk to as we see such turbulence, particularly around that alliance, but particularly around the transatlantic relationship more broadly. Europe feels like it's on its own at the moment. Is that your view as well?
No, not at all. I do think that the president has been very direct about Europeans doing more, especially in defense, but also in the regulatory arena. I know he's talking about that, but the NATO bond is very strong, and I think it's strong because all of us are in it. The 32 allies have made a commitment, and I think we will not walk away from that. So I don't think Europe is on its own, although I do understand the hard feelings about some of the harshness of the comments.
The incoming German Chancellor said yesterday that he feels that Europe needs to be independent of the United States. Does Europe need to be independent of the United States? Does it need to be a relationship more of equals? Because it has felt like an unequal relationship. Europe has existed under the US security umbrella. Does that ultimately need to change now?
Well, I do think that, and really every president with whom I've served has said the same thing. Europe needs to do more for its own defense. And I think that is being said in a different way. But again, we do know that we'd like to have an equal partner with Europe in defense, because our security depends on our being together. Really, the G20 nations in general should be together if we're going to face foes like Russia, like North Korea, like Iran, and then potentially an adversary in China. I think economic unity is going to be our whole card, and we need to do that with Europe and with the other strong nations with economies that can make a difference with China or with any of our other potential adversaries.
Yeah. You, I'm sure, talk to a lot of people that you've worked with over the years about what Europe needs to do. What do you think Europe does need to do? Is it 3%? Is it 4%? Does Europe have the capability, if it wanted to even spend that money, to use that money effectively? What is your assessment of what is required and what Europe should do right now?
Well, I think Europe needs to do more in its own defense, building its military, for one thing.
Yeah.
And the German military in particular has not been able to do offense. They have a military of defense, but we need offense for deterrence. So I think we do need for Europe to spend more on capabilities.
Yep.
And now I think a lot of the capabilities are going to be technology. And technology is the new thing for all of us. And we are going to be investing, as we always do. We have always made security a priority, but Europe has not. They have had other priorities, economic,
Yep.
trade, social spending. And now if they make it a priority, they can do it. And I think it will be important for them to build up so that it is a strength for our alliance.
Yep. If European spending goes up, can US spending go down? Is it a zero-sum game? Is that the right way of thinking about it?
No. The US will not lower our level of spending. I mean, we're talking now about cutting the budget only in places where it's
Yep.
there's waste. I mean, yes, we'll do that, but no, we're not going to go down in our efforts to make sure that America is secure. And I don't think anyone in the administration, certainly
Yeah.
not in Congress, believes that we should lessen our defenses in some way.
Do you understand the Trump-Moscow pivot, the Washington-Moscow pivot that seems to be underway at the moment?
I don't understand it. I do know that sometimes the administration will do something for effect or for some purpose that we don't see yet. We'll have to be somewhat patient.
So you're willing to give them the benefit of the doubt right now?
Well, I don't give them the benefit of the doubt about Russia. I think Russia, it's very clear. Russia invaded a sovereign nation, and Ukraine has fought valiantly. I think our interest is that we not let Putin have a free hand to do something like this, which would embolden him to do more. He did this with Georgia. He did it on Crimea. Now he's doing it with the Donbass part of Ukraine. And if he gets by with doing something like this, he will go into the next country that he can conquer. Yep. And take over. So I don't think that we will have a lasting peace if Russia gets its way and there is no price to pay.
If there are peacekeeping troops put into Ukraine post some sort of a peace settlement, the talk in Europe, and certainly Keir Starmer and Emmanuel Macron will be talking about this in their trips to Washington, the idea is that you basically put European boots on the ground with US air defence, maybe as cover. Is that a reasonable plan? Is that something you could think might be actually viable?
I think that it's certainly a point to negotiate, that it would be with an American support system. We did this in Afghanistan, for instance. The Europeans were there, they were active, they were very important framework nations, but we were doing the air cover, we were doing much that was needed that couldn't be done by the Europeans. I think certainly there is a negotiation there. I don't know where that ends, but I think a peacekeeping place in the Donbass or Crimea is certainly a part of a negotiation. And I think there may be some purpose in the way this has started. I don't see it myself, but it could end up being a good end. I think a good end would be a lasting peace. A lasting peace would mean that, of course, Ukraine is rebuilt, hopefully by Russia, by the Russian assets that are held in Europe and the United States, but also that there be the capability to show Putin that he cannot do this in the next country and then the next country.
Do you think Ukraine should pay for some of that security with its mineral rights? Do you think that is a reasonable trade?
I think I don't know what is being asked. I really don't. I mean, that's being sort of close held. So I don't know what is a reasonable. What I want to make sure that Ukraine gets the benefit of their resources, and I think it is important that there be a development of that, but how that's worked out, I think, is to be determined.
Kate Bailey Hutchison, thank you very much indeed. Very nice to see you. Thanks for stopping by to see us. We greatly appreciate it.
Thank you.
Danny, back to you in New York.
Guy, thank you so much. What a fascinating conversation. Guy Johnson there sitting down with the former U.S. Permanent Representative to NATO, Kate Bailey Hutchinson, at the Bank of America Investor Summit in Dubai. By the way, I would also watch back all of Guy's other interviews. He had a really great conversation with Michael Hartnett of Bank of America and the flows moving out of the U.S. and into China tech. Coming up, more earnings and Fed speak in your day ahead. We'll give you the calendar next. Get you set up for your trading day on this Tuesday. We're going to get retail earnings coming from Home Depot and Keurig Dr. Pepper before the market open. Then Richmond Fed President Tom Barkin speaks at 1 p.m. Eastern. Let's get Apple's annual shareholder meeting that's set for 5 p.m. Eastern with a vote on the proposal of shareholders to ditch DEI. That is on the agenda. Some movers to keep an eye on: Intel, Nvidia. Those are leading lower after the Trump administration is said to be pressuring U.S. allies to escalate chip curbs on China. Alibaba, that rebounds up nearly 4% after its biggest one-day drop since 2022, driven by new U.S. restrictions. Palantir, that is falling 3%. The Pentagon budget cuts are looming. Defense Secretary Pete Hegseth had sent a February 24th deadline for inputs on proposed cuts. All right, let's take you out with a check on this bond market. Bonds are being bid this morning with general risk off. We are lower by about 5.5 basis points on your 10-year yield, 4.34. That's it for Bloomberg Brief. Surveillance will take things from here, and a happy Tuesday to you.